Hey, what's up, guys? It's Jonathan here. So, we just got a long awaited employment report for the month of November, and this is one of the things that the Fed is looking at in terms of determining how aggressive they'll continue being with their quantitative tightening. And we got some pretty weird results out of this report. So, let's take a close look at it. So, without any further ado, let's get right into it. So just on Wednesday, we got the ADP report, which gives us private payrolls. And on that report, a lot of times, the trend usually does follow what we see with the other jobs report, with the other employment and the JOLTS report as well. But this time, it didn't really jive as well as it normally does, at least trend wise. Typically, the numbers are almost always wrong, by the way. So, on the employment report we just got on Friday, the economy added 263,000 jobs, and the unemployment rate stayed at 3.7%, which was the same as it was last month. Now, this is a little problematic because the expectation was that we were going to get 2,000 jobs added to the economy. So it was a pretty significant miss to the upside. So some of the biggest gains in this report came from leisure and hospitality. This is pretty consistent with what we saw with the JOLTS report last month and with the ADP report we got on Wednesday. Leisure and hospitality gained about 88,000 jobs, whereas healthcare gained about 45,000 jobs, and government gained about 42,000 jobs. And then the biggest decliners of job openings was retail trade and transportation and warehouse, which sort of makes sense along. That's still sort of along the lines of what we've seen from other job reports over the past couple months as well. So with the employment report, there's two data sets. There's the household survey data, and then there's the establishment survey data. Now, that with the household survey data, that surveys people individually. So pretty much what they do is they look at one unit of person or one working person, and they ask you, are you employed or not employed? And they take the simple yes or no answer. They don't necessarily take into account that people may have multiple jobs. They just want to know, are you employed, are you unemployed? Whereas the establishment survey data actually surveys the businesses themselves, and they ask the business, hey, what's your head count? How many employees do you have? So, and because they don't take into the fact that those employees in that business might have jobs with other businesses or might have jobs with other companies or other agencies, then what can happen is that it can lead to double counting of workers. So that is something good to know when you are looking at these data sets. The data that we got from the household survey is that the number of unemployed people was unchanged at 6 million people for the month. Permanent job losses did rise about 127,000 to 1.4 million. And labor force participation currently sits at 62.1%, which is about 1.3% lower than what we had in February of 2020 before the pandemic started. Something else I should add when it comes to the double counting in the establishment survey data is that you also got to think that leisure and hospitality is like the typical industry that people will go into to get second jobs or to get part-time work. So like let's say you have a full-time job and I don't know, let's say you're an entry-level accountant or something like that. And you want to pay off your student loans quickly, so you want to get more income. So you take a second job usually at like a restaurant or a bar or a hotel or something like that. That is very typical. So it does make sense that some of the numbers that we are getting for leisure and hospitality may be actually skewed because of this establishment survey data. But anyway, some of the more interesting data sets we did get from the establishment survey is that construction actually gained 20,000 jobs this month, which is very different from what we saw in the ADP report, where it actually showed that construction was actually losing jobs. The construction industry was losing jobs. And the same held for information, financial activities, and manufacturing sectors. So I thought that was a very interesting data point that was coming up. I do believe that when it comes to at least construction, that we will see some softening in that industry. And I think something very important to state with these the economy with this talk about the economy added or subtracted jobs is the fact that even though, like, let's say for example construction lost 10,000 jobs, well, those 10,000 jobs might have been unfilled position anyway. So even though those jobs might be gone, doesn't necessarily mean that those jobs are doesn't necessarily mean that people actually lost their jobs. This means that job openings that once existed don't exist anymore, and that isn't just solely that doesn't solely apply to construction. That could apply to any sector that we talk about. So that's just something to keep in mind. When it comes to wage inflation, the employment report showed that wages increased 0.6% month over month. If you annualize that, that's about 7.2%, and it increased 5.1% year over year. So, given that the year over year number is lower than what we got for CPI, it does give good confidence that we may not have a wage price spiral on our hands. But it still is a very important thing to watch out for is the growth of wages, especially after what we did hear from Jerome Powell, where he's on Wednesday at the Brookings Institute, where he did say that we do need to see some softness in wage inflation if we do want to have wage inflation that is consistent with 2% overall inflation. There was some revisions from the prior months. In September, they revised down about 46,000 jobs. So instead of the economy adding 315,000 jobs, it actually added 269,000 jobs. And then in October, they revised up 23,000 jobs from 261 jobs added to 284 jobs. So overall, the job growth was mostly in the leisure and hospitality sector. And this could be caused, and like I said earlier, this can be caused due to inflation, really from, well, this is obviously caused by demand of consumers, but we could also be seeing these jobs increase as well. So in summary, the job growth was mostly concentrated in leisure and hospitality sector. This does make sense as we still see people traveling and whatnot. It almost seems like now at this point that leisure and hospitality are kind of the last domino that like needs to fall before we finally kind of can see inflation start to tick down. Um, so this is going to be very important to watch out for to see how the demand in travel changes. I think that um, over as the tightening effects of that the Federal Reserve has done starts to get into the economy more, I think that we will start to see inflate. We will start to see demand in that sector start to come down, and hopefully wage inflation as well as job growth will slow as well. So we'll have to take a good look at that. Then, when it comes to what Jay Powell said on Wednesday at the Brookings Institute, the Federal Reserve seems very committed to bringing the labor market back into balance at, in a manner that's consistent with 2% inflation. And Jay Powell did state that he believes that jobs should be somewhere around job growth should be somewhere around 100K per month to keep up with population growth, and that these numbers that we're getting, like 200,000 plus, is shows excess in the job market. Really, the only way that the Federal Reserve can bring the job market back together is with monetary policy. So, um, reducing their balance sheet and hiking rates. Unfortunately, there are other solutions to bring the labor market back into supply. No, most of those are usually what they call fiscal policy, which would be things like if like adjusting tax rates to make it more favorable for people to work, and also net immigration. But obviously, the Federal Reserve does not control those things, so they're leaving that more to the hands of the White House and the Congress to deal with that. So I don't think that the Federal Reserve will necessarily hang their hat on this report. I think that they the Fed is doing a good job, or at least from what we're hearing from the Fed, it seems like they're doing a good job delineating the fact that a lot of the job growth that we are getting in our economy is mostly focused around one sector, and that once people run out of excess money to spend in that sector, then we will most likely see the job growth in that sector collapse. So I think the Fed will be more focused on the CPI report that we get on December 13th, right before the FOMC meeting. And I think that's really will be the big tell about what we will see, what kind of the level of hawkishness that we'll get from the Fed. Another thing I wanted to add as well is that we have to remember that jobs are a lagging indicator of a recession. And this is something that I've been talking about for the past couple of months, is the fact that um, jobs that you have to understand, and this is why I think it's so important for people to understand macroeconomics. Really, people who do have W 2 jobs as well, because it's when things are going good and unemployment is low, it's much easier for you to get a job that pays more and for you to save money so you can get prepared for a possible recession and in turn possible job loss. But the problem is that if you don't prepare for a recession before the recession happens, then when the recession happens, which a lot of times people will lose their jobs during the middle of a recession, it's very hard for you to get a job that pays the same, if not even more. So it's very important, at least from a personal finance perspective, that you prepare for a recession by trying to get out of debt as much as possible, and trying to slash your expenses and save money and have an emergency fund in place, because the recession can happen really quickly. Employment and unemployment can shoot up very quickly. That's something I wanted to add there. But pretty much that's all I got for you guys for this video. Thank you so much for watching. I'll see you in the next one.